My name is Ed Derbin from the New Economic Paradigm Associates, and this is a podcast for our economic newsletter for the new millennium. So, looking just recently, the number came out for the real GDP for the first quarter of 2019. It was published at the end of April. And again, what we're looking at when we're talking about the real GDP, this is published by the Bureau of Economic Analysis, and it came in at a 3.2% annual growth rate for the first 3 months of the year, for the first quarter, January through March. And so in this presentation, we want to walk through that, the ramifications of that, what to kind of expect going forward, and what does this actually mean? Because again, that number, that economic growth rate number was surprisingly high, at least for most of the media considered it. They were looking at a number that was significantly lower than that. Again, that 3.2% is reflective of it's the annualized rate for just that first quarter. So when we talk about macroeconomic indicators, there are three basic things that we look at. One is economic growth. Again, that came in at 3.2% for the first quarter. Another would be labor markets or the employment situation. And for March, the number came in for the U3 unemployment rate at 3.8%. And keep in mind, the U3 unemployment rate is the official unemployment rate, the number that is referred to, or the number that we see on a monthly basis that's published, if you will. And it came in at 3.8%, and that's a very low number. Typically, the full unemployment rate, it's a little awkward phrasing, but is about 4%, or maybe even higher, anywhere between 5 and down to 4%. So we're a bit lower at 3.8%, which could indicate that the labor markets are tightening a bit. So there's a concern for that. Lastly, we consider price level changes and inflation in particular, and this is measured again through the BLS, which also measures the unemployment rate. The BLS is the Bureau of Labor Statistics, and for the Consumer Price Index for March, it came in at 1.9%. What they do is they measure for the preceding year, so going back 12 months. So this is kind of the lay of the land that we're starting with, and we want to dig down a bit into these numbers in this presentation. And again, keeping in mind that these numbers again are coming from the Bureau of Economic Analysis for the GDP and the Bureau of Labor Statistics for the employment numbers, and also for the inflation numbers. Okay, and so let's get started with the GDP first off. So GDP again at 3.2% is reflected. It came in at $588 billion for the first quarter of 2019, and that's a very strong number, and it's the best number, the best reading that we've had since the first quarter of 2015. And what the concern out there with this is, and again, it's a great number, but there's a concern that perhaps we're growing too fast. And this, of course, when we were talking about growing too fast, there are concerns about sustainability, and also concerns about the prospect of inflation, picking up as a result of this robust, or too robust, if you will, economic growth. And when we talk about sustainability, you have to understand that this 3.2% growth rate, if it's sustained over the course of the year, and at this point, it seems likely that it would be 3%, and perhaps even more than 3%, 3.5%, maybe even approaching 4%. But at any rate, this is the first time since 2005 that we've had a GDP number, an annual GDP number, that real GDP number that came in at 3% or better. So it's been a long time. And when we talk about 3%, to put it in the proper context, prior to the recession, and prior to the 2000s, if you will, that was about the average annual growth rate, about 3%. So we've really cut back. This is, some have referred to it as the new normal, where we would have economic growth in the 1.5% to 2.5% range. so we're heading into kind of new territory or ground that we haven't covered in a number of years. So keeping this in mind, this is some cause for concern, but this is also something very positive. Okay, so when we looked at the labor numbers, to kind of break this down a bit, looking at one is that we see this U3 unemployment rate being very low at 3.8%. And this is, again, the cause for concern of that is that if the number is that low, and if you have sustained economic growth going forward, that of course requires more people. And if there are not more people that are available, then that could result in wage inflation, and that is kind of the concern. The underlying concern is that inflation coming from the labor markets, if you will. This is called cost push inflation, coming from the resource markets, the labor capital entrepreneurship and land portion. In this case, we're talking about the labor portion. But to kind of put this into context, there's also what's referred to as a labor force participation rate, which we've looked at quite a bit. We've discussed this repeatedly going back several years. I think the first mention that we had of it was as far back as 2010 in the newsletter. But the labor force participation rate, what that measures, first off, when we talk about the labor force is equal to those folks that are employed plus those that are unemployed. So that's the number that would be associated with it. And that's divided by the civilian non-institutional population. And the civilian non-institutional population consists of those folks that are 16 years of age, so basically adults 16 years of age and older, that are not institutionalized, not in the military or not incarcerated, not in nursing homes, etc. So that would be the denominator, and then the labor force itself would be the numerator. The labor force, again, is equal to those folks that are employed plus those that are unemployed. So the takeaway from this was that maybe 10 years prior to the Great Recession in 2008, we had an average labor force participation rate of 66-67%. So it was quite strong. Subsequent to the Great Recession, starting from this, with the number that we're looking at, it would be in late 2009. The number was at 65%, and it's dropped down to the current 63% level in 2019. Some of that is owed to, or a good portion perhaps, is owed to the fact that baby boomers are leaving the labor force, are stepping out altogether, moving into retirement. Remember, the baby boom goes from 1946 to 1964. But having said that, if we drill down on the younger age cohorts, younger age groups, what we find is that the participation rate is actually quite low in the younger age groups, and ironically, the older age groups, we'll just say this, 55 and older age groups are participating at historically high levels at this point. So the takeaway from this is that there's still room for pulling more people into the labor force. There are a lot of people that are on the sidelines because, again, the U3 unemployment rate counts those people that are unemployed, but are only those that are actively seeking employment. So there are a lot of folks that are on the sideline that have given up looking for work, even at this stage of the recovery, if you will. There's a tendency out there to look at the labor markets and say, oh well, we're full up, and the 3.8% is very low unemployment rate, and any more pressure on the labor markets would just be inflationary. But the fact, again, is that there are a lot of people that are on the sidelines that should be pulled back into the workforce, including should probably be or could probably be participating at a higher rate, even those folks that are 55 years of age and older. So at any rate, making an adjustment for this, and this is our rationale for making this adjustment, is that while we're not looking at getting back to the 66-67% participation rate, that would be nice. The fact is that a lot of the baby boomers, again, are retiring and are staying out of the labor force. But again, because of those younger age groups that we're talking about, the 16 to 54-year-olds, they're participating at a lower rate than they have in the past. There's no reason why they should at least be participating at the previous levels, and they should. So the takeaway is that they're just by making this adjustment, moving from the 63% up to the 65% labor force participation rate, there's a difference there of at least 5 million people. And I'm saying the 5 million, I'm saying that's a conservative number. There are at least 5 million people that are available out there that should be in the labor force that are not currently in the labor force. So again, the takeaway from this is that there's some slack in the labor markets that is kind of hidden out there, that hidden unemployment to the tune of 5 million people, which of course would adjust if we adjusted our unemployment rate to reflect that. The 3.8% unemployment rate could move up to a bit closer, if you will, to the 7% unemployment rate, meaning again that there's a lot of slack in the labor markets, meaning that there's room for growth, there's room for the economy to expand without seeing a lot of inflation coming from the cost on the cost push side coming from the labor markets. Okay. So the next thing we're looking at would be for looking at the economy and kind of on the other side, but this is also this is a cost push related item, but it's an important thing to point out is that when we talk about price level changes, what prompts price level changes and the mechanism for that inflation that we're talking about, it would be it occurs at the firm, meaning at the businesses raise prices, and the reason that they raise prices could be because of the cost of their labor, for example, is going up, or the cost of their energy, in this case, the cost of their fuel prices, etc., going up, and they would pass those on to the consumer. This would be cost push inflation. And the general side, so far as the demand pull inflation is concerned, would be coming from the other side, the consumers demanding more goods from the firms, and this is referred to as demand pull inflation. Think about it in terms of too many dollars chasing too few goods. We'll leave it at that. But stepping back, we looked at labor. Now we want to look at this in terms of energy, the energy part of the equation. And this again has to do with price level changes, has to do with inflationary pressures in the economy, etc. So the takeaway from this is the big picture when we're looking at the overall energy picture. And a lot has been bandied about concerning rather about energy independence for the U.S. And surprisingly, looking at the data, we are very, very close. The U.S. is very close to being actually energy independent. We talk about energy, this is a breakdown, all energy products, and looking at it in terms of net exports. Net exports are exports minus imports, and this is all measured through the Bureau of Economic Analysis, again, through as tabulated with the balance of payments accounts. So energy, the breakout of energy would be, again, with exports minus imports for petroleum, crude oil, fuel oil. So when we say petroleum and products, those would be the resultant products, gasoline, kerosene, etc., all the other byproducts that come about in the refining process, but also the crude oil, fuel oil, which is also part of that process. And other petroleum products, liquefied petroleum gases, which would be coming from the result of natural gas, coal-related products, natural gas itself again, and also nuclear fuel and electric energy. So when we see electric energy, for example, this would be imported or exported electric energy. So the imported side might be something electricity being imported from Mexico or from Canada. Canada might be from through Niagara Falls through its hydroelectric, for example. But the takeaway from this is that going back to 2008, we were importing to the tune of well over $400 billion of our energy, overall energy, and in 2018 we were down to $41 billion. So there are a couple of things, well, there are a lot of things that are going on behind the scenes, but one of the takeaways is that with our trade deficit, by removing some of this imported oil, it's helped us domestically for a variety of reasons, but it's also kind of pointed out the reality that much of our trade deficit is owed to, at least on the goods side, would be with China. So this is, again, another topic going forward, but it's something to kind of keep in mind. So drilling down again on those exports, on the energy, the crude oil. Crude oil is very interesting in that, again, it constituted, going back to 2008, it was a huge portion of our overall energy budget so far as what we were importing, and we are still importing a good deal of our crude oil. There's no doubt about that, but what's interesting to note is that moving again from $342 billion down to $113 billion or so in 2018, from 2008 through 2018, that reduction in the crude oil overall net exports or imports, if you will, moving down to $113 billion in 2018, is that this also takes into account increased economic activity. So this our growing economy, and also if you factor in the other turmoil that's constantly roiling out there around the globe, with Venezuela, for example, and Iran, all the things that would be associated with that, which could drive the price of crude oil up for sure. So this is, again, one snapshot, but again, this is a vastly improved picture, and I have no doubt that going forward for 2019 we'll have an improved number so far as the crude oil, this net export number. So the next we're looking at, this is the real, this is an amazing thing looking at our natural gas, because natural gas, even though the numbers are significantly smaller, if you will, the point is that we've moved from an importer in natural gas to a net exporter in natural gas, and keeping in mind that this is, again, increased economic activity, increased GDP, which requires more energy, if you will, and also keeping in mind that much of our electricity production, our utilities production has moved increasingly toward natural gas because of the increased supply driving the price down, making it more economically feasible to do so, in addition to issues associated with the production of greenhouse gases, moving away from coal, for example, more toward natural gas so far as our energy source is concerned for the production of, again, that electricity. So the next we're looking at, this is kind of an aside, but coal. Coal, because we've moved away from our coal for the production of electricity, not entirely, but we've moved quite a bit away from using coal as our main source for electricity production. We're exporting a lot of coal. We have a lot of coal. We have 200 plus years of proven reserves of coal. So it's something that is another kind of an issue to keep in mind as well. This is all adding to that driving down the overall energy dependence, if you will, moving us closer toward that energy independence along these lines. So looking ahead, with the takeaway from all this, wrapping this, trying to put this together, is that the question is that that this 3% real GDP mark, all the concerns with inflation and so on and so forth that are associated with it, there's no reason to believe that we won't hit that 3% mark going forward for the year for 2019, or an even higher number, but you never know. There are things that could happen external to the economy, these shocks that occur, exogenous factors, things from the outside that could cause this to change. Things change, things happen all the time. So keeping this in mind, at least at this juncture, at this point, that 3% real GDP mark for 2019 could and should probably be north of 3.5% for the year. So this is keeping in mind, walking through the issues that we were talking about, kind of revisiting them. The labor markets should easily be able to absorb the 5 million people on the sidelines. And what I mean by that is this is over a period of time, because our labor force is continuing to grow. On a monthly basis, we add about anywhere from 180 to 200,000 people into the civilian non-institutional population, and that provides more, if you will, more labor to be absorbed into the economy. And then on top of that, we have an additional 5 million people that should be absorbed over time, maybe over the next 5 years. So there's a large buffer out there that is of folks that for the labor market that is kind of unrecognized. There are a lot of things that go along with that. Okay, the reality of recording things. Alarm went off. At any rate, so with the labor markets, we're looking at some slack in those labor markets. There's room for growth going forward. And the next portion, when we're talking about this is all dealing, relating to inflation. So the problems associated with inflation. The labor markets should be in good shape for several years to come, meaning continued growth for several years to come. Could we have the labor force out there that's ready and available to do this? Currently, domestically, right now, we have this labor force. There are a lot of mismatches out there so far as the quality of the labor that we have domestically. But those are things that can and should be and will be addressed over a period of time. And also the other piece that we looked at was so far as the energy production was concerned, in our domestic production, I'm contemplating, and it's not far off, we were very close last year, I'm thinking that in overall sense, our energy picture, we will be energy independent in the year 2019 or 2020 kind of going forward. And what that does is that by this continued expansion through fracking, through such things as Marcellus shale in Pennsylvania and in the Appalachians, so far as the production of natural gas is concerned, Eagle Ford in Texas, and also the Bakken in North Dakota, and continued finding more shale deposits out there, more hydraulic fracturing, recovering more oil, more natural gas. This will serve to moderate prices, because simply put, if the price, the world price of energy goes up, the world price of crude oil goes up, what that does is it affords us, meaning domestically in the U.S., it brings more production online, simply put. So we're producing more domestically, and that has a twofold impact. One is that it adds to our economic growth in terms of our GDP, and two, it helps to moderate prices, to keep prices at bay. The world market price, the world price out there, and that of course helps to tamp down any kind of inflation. And there's the other aspect that we were talking about in terms of overall competition in the U.S. economy, the market structures, if you will, out there in the U.S. economy. We have a highly competitive overall economy at this time. I know there are lots of exceptions that we could point to, but in an overall sense, in aggregate, we have a very competitive economy. And this competition is the driving force also to keep those prices down, to protect us, or to keep the demand pull inflation somewhat at bay. Because what competition does in the overall sense is that it prevents producers, it prevents businesses from raising prices, from gaining market power, from having price power in a larger sense, if you will. So the other thing is, the other wild card that we have so far as the economy is going forward has to do with government in terms of the monetary policy stance of the Fed, for example. The Fed, as in the Federal Reserve, more specifically the Federal Open Market Committee, and that is where the monetary policy is arrived at, and it's through them that it's implemented. And what we mean by monetary policy, of course, has to do with interest rate, the Federal Reserve, the federal funds rate, and so on and so forth, impacting that. And so with the Fed, they're constantly monitoring all the things that we're talking about so far as economic growth is concerned, so far as the macro indicators, and also several micro, of course, drilling down. But the macro indicators with the economic growth, the robust economic growth, are we growing too fast? With the labor markets, our labor markets actually to the point where they're too tight, and we've somewhat dispelled that, hopefully, or we've explained some of that to the point where it should moderate or reduce some of the fears associated with labor markets being too tight, if you will. And lastly, of course, would be in terms of price level changes, inflation overall, and this inflation will continue to be moderated, at least so far as energy prices are concerned. Going forward, they may pop up. So there's no doubt that we will have increased inflationary pressures, for example, on the energy side going into the summer, or with continued economic growth, continued demand for energy, and also the continued disruptions on an international basis around the globe associated with wars that flare up, etc. But due to our domestic production of energy, of oil, of natural gas, and the like, for example, that should help moderate, should help to reduce the impact of that inflation. So the other part of this is the Federal Reserve side, and so on the fiscal side, I went a bit far on that, but on the fiscal side has to do with taxes and spending. So we're looking at it at the national level in terms of Congress, etc. And there's what's curious is that with the tax cut that we had, we've seen increased deficits. So but what we have seen is an increase also in tax receipts coming in. And it'll be interesting to see what comes up in over the course of the next month in terms of tax receipts, if they in fact are on the rise, if we are having higher tax receipts even with a tax cut, which is again for another discussion. But if tax receipts are on the rise, and also if on the fiscal side, if we're able to moderate a bit we're spending, if we're able to pull back a bit on our spending, to reduce spending, and that of course is probably not going to happen, but at least to keep that spending at a reasonable level, that would be very helpful going forward. So there are a lot of wild cards that are out there, but overall the economy looks good for the year 2019, and we'll see how things are going forward. Thank you.